I'm Howie Lim. This is Money Hacks by the Business Times. Gold has consistently been considered the quintessential safe haven asset, offering a lustrous sanctuary during periods of economic unrest. Notably, 2024 has been an exceptional year for gold, solidifying its position as one of the top-performing assets. But according to some, gold has generated disappointing long-term performance compared to equities. Now I'm confused. So should we or shouldn't we be investing in gold, and how exceptional is it really? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. And helping us out today are Stephanie Leung, StashAway's Chief Investment Officer, Robin Tsui, the APAC Gold Strategist at State Street Global Advisors, and Fan Shaokai from the World Gold Council. He's the head of Asia Pacific ex-China and global head of central banks there.
Thank you for having me. Why gold has gained so much traction recently is, I think, from a policy perspective, we're moving into an era of extreme uncertainty. We don't know what trade policy will look like. We don't know what some of these international relations are going to look like from a day-to-day basis now. That's also translated into economic uncertainty as well. Of course, tariffs might bring inflation, it might bring recession, and then how central banks will react to that with monetary policy, also much less certain than we were a few years ago even. And then on top of that, we have these sort of longer-term changes that might be brought because of this. The relationship of the United States with the rest of the world, and by extension, the US dollar and the rest of the world. What is that going to mean for the international monetary system? So all these uncertainties, I think, are really fueling a lot more interest in gold.
Gold has been the asset class that really shined through this year. Year-to-date performance, gold is actually up almost 30%. And of course, it's given back some of its recent gains, but still, it's one of the best performing asset classes this year. And like other metals, gold is store of value for some people. And also, more importantly, it's a store of value for central banks as well. Historically, gold has outperformed during periods of uncertainty. Gold has been a very, very good balancing asset. From a portfolio perspective, you have risky assets like equities, high-yield bonds. These give you higher returns, but these come with bigger risk. In terms of, for example, equities, every few years you would see kind of 10-20% drawdowns caused by different things every time. What's happening this year, it's been caused by the trade tariff and some of the other policies that are introduced by the Trump administration. In these kind of periods of uncertainty, the balancing assets actually would provide what we call protection for a portfolio.
If you look at gold price during the first 5 months of 2025, it's up about 25%, but relatively it's still one of the best asset class comparing to global equities and global bonds. There are a few core reasons or key reasons why gold is gaining ground in terms of the price. We are still leaning a very bullish short and over the long term as well for the gold prices. Some of the factors ranging from the economic tactical factors to the structural factors. The economic factors will be the trade tension between the US and China and also the rest of the world. That has put a lot of uncertainty in the market. Investors are using gold as a way to diversify their holdings into equities and bonds because investors around the world, including Asian investors, they are uncertain how the economy will play out, especially in the next 6 to 9 months. Geopolitical tensions, the rising risk of recession because of trade war. The market do expect the Fed to cut rates as well. So all these factors will be quite supportive of gold because there will be more safe haven buying.
Great. More buying equals more price increases, which means gold will be more expensive to buy. Does this mean we don't get to enjoy the diversifying effect of gold and how it helps to hedge against inflation in our portfolios? Maybe retail investors have missed the boat. Here's Fan Shaokai again.
I totally understand those sentiments, but I think it actually is important to look at gold in terms of how it performs within a portfolio. I don't think you should ever have 80% allocation to gold, for instance, 90% allocation to gold. If you're looking at gold like you would a tech stock and just hoping that it'll be your ticket to retirement, that's probably not the right way to approach it. Our way of approaching gold is that it's a really useful tool within a portfolio to diversify, to maybe achieve better returns on a portfolio level, and to basically use as a safeguard or to bring resilience to portfolio. So understanding how much allocation is important, but also in terms of your question of timing, because of course the gold price has gone up a lot. Yes, the price is higher, but you want to see how gold performs within a portfolio. And if you think the performance adds value to your portfolio, then entering at this price might be okay because you're not really buying it for its appreciation. You're buying it for its utility as a diversifier.
That's always the question we've been getting. All this strong demand from global investors through the ETFs, through central banks, through the rising demand from Asian investors have put gold price to a fresh records, hitting 3,000 and 3,500 a couple of months ago. But we do think there's more room for gold to run in terms of we do expect gold price will trend higher in the coming 6 to 9 months. The factors I mentioned, trade policy, the ETF flows, recessional risk, rate cuts, those factors will be quite supportive for gold. And over the long term, we expect to see more central bank purchases, the rising debt level in the US. Central banks and investors might rely less on the dollar and purchase more non-US assets, including gold in the future. We do expect in the second half of this year, we do have a base case and a bull case. In our base case, we do expect gold price to hit 3,500, which we saw that a couple of weeks ago, but we still believe quite confidently that even if the trade tension moderates, the strong buying from investors and central banks will push gold price to the 3,500. And if investors do think the current level is expensive, you can always buy through an ETF. If you buy through an ETF listed on exchange, potentially you can get exposure to gold. So that kind of minimizes the cost of investment. You don't have to buy 1 ounce of gold. You can actually minimize it.
Still to come.
Price is important, but you should look at how gold reacts within a portfolio and the value it can bring, and then decide.
Historically, gold has not only outperformed equities, but also would go up in absolute terms when equities fall.
More on whether we should invest in gold with our experts when we return.
Breaking news from the Business Times podcast team.
Hi guys, this is Emily Liu, your host of Market Focus Daily. I've got some great news. Come July, Market Focus is getting bigger. I'll be bringing in market and investment experts into the studio to share analysis and opinions on what moved the markets and what to look out for in the week ahead. Every Friday, starting on July 4th.
Look out for Market Focus Weekly from the Business Times or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back.
We do have a bull case that gold price could hit 3,900. And for this scenario to occur, that has to be escalating tensions around the world, including the issue of stagflation and also the less reliance on the US dollar.
$3,900 an ounce for gold. Wow, that's a lot. Really sounds price prohibitive for some. Maybe there are alternatives which function the same way gold does as a safe haven asset. Here's Stephanie Leung from StashAway.
What are the other credible store of value, or what are the other credible alternatives? Apart from gold, silver may be close, but if you look at central banks, they're not buying silver, right? They're only buying gold. Maybe think about Bitcoin. The US administration, they're trying to include Bitcoin in the strategic reserve. So there may be some tailwind. But also, that asset class is very, very volatile.
I would say that they're very different metals than gold. One of the reasons that gold is seen as a liquid asset class, a reason that it's embraced by central banks as a reserve asset, is because it is much more a financial asset than platinum and silver. Those metals have industrial uses as more of sort of the reason why people buy them, right? Gold is half used for, a jewelry and sort of industrial uses, half used for financial purposes. So much more of a financial asset than the others.
Sounds like a no from Fan Shaokai of the World Gold Council as well. Now what? Oh, what about the US dollar perhaps?
So interestingly enough, we just released our central bank survey, which we do every year. As I mentioned, central banks are very big buyers of gold. They're also very big holders of dollars. And in the survey, they actually noted that they think the dollar's role as a reserve currency is going to decline, and that measure of decline in our survey has picked up in the recent years we've done this survey. So it looks like in general, central banks are more pessimistic about the future role of the dollar. About 75% of respondents say that the dollar's role is going to be less in 5 years' time than it is today, at least in reserve assets. It's the exact opposite picture when we ask the question about gold. About 75% of central bank respondents in the survey say that gold's role is going to rise in 5 years' time. So more pessimism about the role of the dollar, more optimism about the role of gold. How that might translate into the value of the dollar and the value of gold is not exactly certain, but I think in general, there's a lot more reticence, a little bit more hesitation on embracing the dollar right now. And I think it also reflects fears about U.S. debt sustainability, for instance. Right now, Congress is debating a very large new budget, which includes some increased spending and tax cuts, and that might increase the U.S. deficit to even higher levels. So I think that's also weighing on the minds of investors and by extension, their views of the U.S. dollar as well.
We're actually quite bearish on the dollar because we expect rate cuts that will put pressure on the US dollar. And we're looking at the US deficit, which is projected to increase about 7% of GDP. And then if you look at the overall federal debt in the US, it's about 34 trillion US dollars. So that amount of debt is actually quite worrying for a lot of central banks and a lot of investors globally. US ratings got downgraded by Moody. So we do think over the long term, the US debt will continue to rise. And that is going to impact the US dominance in the world. Of course, we do think US will still remain the world reserve currency. But we probably expect more central banks, especially the emerging market central banks, including China or the bigger ones, they will want to diversify their US holding.
Sounds like another no. Let me think. So with Fed decisions looming and market swings ahead, gold investors need some targeted strategies to navigate challenges. What might those be?
A very common strategy is just dollar cost averaging. If you have decided that you want to increase your gold allocation, then you buy a little bit over a period of time, and then you just iron out the creases essentially in that volatility. You can, of course, decide to try to look for dips in the gold price, but I don't know if that's necessarily a particularly useful strategy because you just don't know where the price is going on a day-to-day basis.
So the first question every investor before you invest is to ask yourself, what is the risk I'm willing to take? Gold still is a balancing asset. So over the long run, it would give lower returns than equities. It sort of balances out with the risk. If you're a growth type of investor, then maybe gold is a lower portion of your portfolio. If you're much more defensive, then maybe gold would be higher. But of course, every investor is different. So we have to understand the investor's risk appetite and number two, time horizon. The main drivers that would drive gold are, number one is the real inflation, nominal inflation, take interest rates out of it. Does bond actually give you positive returns after inflation? What is gold competing against is basically government bonds. So if government bonds are actually offering higher return after inflation, that makes bonds more attractive and gold relatively less attractive. But if bonds are not offering you any positive returns after inflation, then what's the reason for holding bond, right? Because gold at the end of the day doesn't pay any interest rates. You have to think about what is the real interest rate from holding government bonds. So that's number one. Secondly is the uncertainty around the macro environment. Typically, gold performs well when there's more uncertainty, when there's geopolitical concerns, when there is uncertainty around the inflation outlook, etc.
Takeaway order Money Hacks 225 is ready. Why this sudden Midas touch? Blame it on global uncertainty. But gold, it's not just for pirates and pharaohs anymore. This lustrous metal has been having a moment, shining brighter than a supernova in 2024. While some grumble about its long-term performance compared to those flashy equities, gold has been busy outperforming pretty much everything else, making it the asset class this year. A big thank you to Stephanie Leung, StashAway's Chief Investment Officer, Robin Tsui, the APAC Gold Strategist at State Street Global Advisors, and Fan Shaokai, Head of Asia Pacific ex-China and Global Head of Central Banks at the World Gold Council. I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.